Um, Look, I'm going to talk a little bit before we go through here very quickly about what's been happening recently with Newmont, and it's not an interpretation of what's happening with Newmont specifically, but rather through the whole industry. Newmont has reported earnings yesterday, very good earnings, right? I mean, it was more than 20% above the EPS estimates by analysts, was about 110 or 111% relative to the prior quarter, to the quarter, same quarter from last year. So very, very good bottom line results. And the conventional view looking at this has been, how in the world is this stock down with earnings improving, right? I mean, that's been the kind of consensus view on this whole situation. Well, let's take. I think it requires a little deeper look into this because it does have a very important message for the overall industry. This disappointment came especially because of production guidance, which was guided to be exactly or very much the same as the guidance of this year for the next year, right? So there's pretty much no growth of production. All right, so this is how I see it. Maybe we can take Kevin or Quinton's views on this as well later. The way I see it is that the market is now starting to realize that these companies are starting to run into growth constraints, right? I mean, we know that these large mining companies have been, for the most part, depleting their reserves, not investing in exploration. Their exploration budgets have been extremely low relative to history, and doing very little to acquire new deposits that could come online anytime soon. So what happens next, in my view? This is one of the first times in this cycle that we're seeing the market, investors, demanding growth, right? I mean, I've seen Newmont, I've seen Barrick, all these guys saying, we're not focused on volume, but the market is saying, we want you to be focused on volume. We want you to grow. How do you get to growth if you are one of those major companies? Well, the easiest way, well, you can spend more on exploration. We've seen some acquisitions among the major companies. That's extremely hard. If you're into, doing acquisitions and all these things, acquiring another major company is if you want to explode your head of complexity, that's what you do, right? That's extremely complex and difficult. We've seen a lot of those happen recently here, right? Major companies merging with other major companies or mid-tier companies. We've seen that most of it already. The way to do it, and we know exploration is extremely hard, right? I mean, how many companies out there today? There's, multiple companies, thousands of companies in the mining industry, and only about, 5 to 10% of those companies actually hold high quality assets, particularly in the exploration phase. And so exploration is risky, it's hard, it's rewarding on the other hand when you get it right. And I think that this is a pivotal moment for the earlier stage companies, because these companies, the major companies, are going to be under pressure to grow. And I view as the simplest way to grow, acquiring small companies, acquiring stakes, either equity stakes in these companies or outright trying to acquire their assets. So if you are, I think, my 2 cents, buckle up for what I think it's going to be a major M&A cycle. Again, just to reiterate, not among the major miners themselves, but really across major companies looking to acquire the smaller companies. Again, this is just my view. And this is how a mining cycle tends to unfold. The capital flows into the major companies first, and then it starts to flow down into the smaller names. So welcome, in my view, to a mining cycle, a classic mining cycle. Game on. That's my 2 cents. All right, let's go to the next chart. Gold to silver ratio. Now, we're talking or sending emails back and forth with Jim Wise, who works at the San Cristobal mining company. And, he reminded me of a very long-term chart looking back of the gold to silver ratio. I wanted to give more statistical evidence of where we are historically speaking. The historical average of this ratio going back to the 1600s, right? So there's a lot of data here. 1600s was about 29.17, so about 30 on the ratio. Today we're sitting at around 85 or so, depending on the second that you look at. The second or the two standard deviations away from or above from the historical average would be about 50.6. And today we're about 2.58 standard deviations above the historical mean. Okay. Historically, what we tend to see is that, back in the early 1900s, we did see that ratio at around, for about 3 years above this 2.58 level that we are today. And if you can look at this as well, we did see back in 1970s, this ratio go above the same level for about 2 years. So 3 years first, 2 years. And if we exclude that briefly moment that we saw, maybe we should subtract, and not say it's 5 years, but we should subtract that moment that we saw briefly in the last 5 years that went below that. We've been essentially above this 258 standard deviations above the mean for about 5 years. And I think we're getting ready to break that level in a very large way as we see a cycle unfolding. I've never seen, I think the big question for investors, when you look at what the damage we saw daily on the sell-off is, there's three things you need to think about, right? Is this the end of a cycle? Are we going to be going through a consolidation period? Or three, this is not the end of a cycle, and this resumes to what we've seen in the last 12 months. I think it's easier to approach these types of questions or these types of possibilities in markets by trying to eliminate at least one of them. And I would, in my view, attempt to eliminate the fact that we're probably not in a peak of the gold cycle, as Kevin was presenting as well. I've never seen the peak of the gold cycle happen with the gold to silver ratio at 85 or so, right? Usually in 2011, actually, we saw go down to 30. If we go back to the 70s or so, we saw that, or back in the 80s, actually, we did see that ratio go down all the way to 20 or so. This time, given the level of extreme imbalances we have worldwide, would not surprise me at all to see even worse than that. So I think this is extremely bullish to the whole, mining cycle, to the precious metal cycle, to the potential of a long-term bull market here. I'm very excited. I think this is not the time to be panicking and saying this is the peak. I think this is the time to be looking at deploying capital. My 2 cents. Let's go to the next chart. Three things happened recently with Scott Bessent. He made a few comments that I thought was remarkable. One, he said that there has been a lot of, and by the way, I have huge respect for Scott Bessent. I think he's one of the smartest macro brains in the world today. And I think it's, I'm not a US citizen, but I think it's a pleasure to have him as a Treasury Secretary of the US administration, personally. It's not a political view. It's a view about how smart this guy really is. And I think some of his comments recently are really interesting. First, you can see Bessent on surge in gold prices, more buyers than sellers. And then he said, gold prices are rising. Gold prices rising has helped the US substantially. Well, US reserves, assuming those reserves are real, it's sitting at about $1 trillion at current gold prices, or about 4,000. I want you to think about something just quickly. If you were thinking about, there was a whole discussion about revaluing gold at the beginning of the year, and Bessent was asked that question, would you revalue gold and so forth? And he said, no, I'm not thinking about that. Logically and rationally, that actually makes sense. Why would you just revalue gold prices when you can actually acquire that in the market and drive prices higher and accumulate more of the metal? I think rationally, that makes a ton of sense. What I disagree with Bessent, and I understand he's trying to do his job, is on the left. I know it's a small here, but you can read it on Twitter if you want to go to his page and look into that, where he's saying that the deficit is actually shrinking dramatically. I agree with the views of folks like Luke Roman that have been saying that this is an accounting gimmick that is really causing the deficits to fall. What is the real measurement of improvement on that front? Let's go to the next chart. Sorry, this is not a chart of gold. It's actually a chart of the federal debt outstanding, just to clarify. But this would show us that deficits have been reducing, and we're not seeing an exponential growth of federal debt outstanding. Now, somebody, Hugh Hendry, which I also have respect on the macro side, made a comment that unfortunately I disagree. And first he said that today's dollar, so monetary base is sitting at about $5 trillion today. Monetary base, right? That's your first level of money in the system, and money circulating in the system, dollars. We have about, I just said, $1 trillion, supposedly, assuming those reserves are right and Fort Knox and so forth, $1 trillion sitting at the U.S. government today of gold. So he said for every $1 or $5 of monetary base, you have $1 worth of gold. So it's backed by gold for a 5-to-1. What I think it's interesting about that is actually if you do the total debt that we have in the federal outstanding, just do the math right now, it's sitting at around $38 trillion with $1 trillion. So that ratio is actually 38-to-1. I think that's the real ratio. And his reply was, well, you should be logging the federal debt outstanding. You know why you do that? You do that to show that that growth is maybe not as exponential as it looks, because it smooths out the growth factor of any chart. Let's go to the next one. Well, I logged it. Let's go log the federal debt. Are you seeing a base there? I'm not seeing a base. I'm not seeing it is stopping growth at all. And I see a linear, basically, growth of the debt. I'm not seeing a deceleration. In fact, in the last 12 months, the federal debt is growing at around 9% year over year, right? So take your investment. By the way, interestingly enough, I think Ronnie Sterfele made that point as well. Since the 1970s, gold has compounded about 9% growth annually. I guess that's in line with debt growth as well. If the chart is linear, and we've seen about actually historically as well, 9% growth on the federal debt outstanding. And this year has been in line with that. So no, we're not seeing deceleration. We're not seeing decline. We're actually seeing this, in line with what we usually see. We could see a lot more, as the government shutdowns potentially ends and maybe opens up even more spending on that front. This could get very interesting. So no, I don't think we're seeing any improvements on deficits. Wake me up when we see that. And I think that the thesis remains very compelling for hard assets and precious metals, in my view. Let's go to the next chart. Next chart, we're looking at another way to calculate this. Is just looking at U.S. gold reserves. And this is the way I should have approached the idea about Hugh Hendry, right? Instead of doing the 38-to-1 ratio of U.S. debt outstanding relative to gold reserves, we can just say how much of U.S. debt is backed by gold. It's about 2%. 2% back in the 1970s was about 17%. And I know people have changed the narrative, and I love when people do that. Like right now, you talk to somebody about what is the U.S. Treasury backed by? They say, oh, it's military. It's the military strength of the U.S. economy. Honestly, I don't believe in that. Back in the days, no, decades ago, I wasn't even alive. The whole point about owning treasuries is because it was backed by gold, right? And in a substantial way. That's the whole point of owning treasuries. And then as we enter a very undisciplinary world, folks have started to change that and justify by these, in my view, kind of stupid ideas of it's backed by military support. I don't believe in that at all. If we go back to levels that we used to be backed by in the 70s or 80s at 17%, implies some crazy gold prices. And I'm not here to imply that at all. I'm just saying, as an investor, you're always trying to think about what's the intrinsic value of an asset. This is a good way, in my view, to sort of think of that way. And if you want to go back to the World War II environment, where the U.S. government, a little bit before that, debt growth that we saw to finance the war, and the debt used to be about 40% backed by gold. I don't think we even want to talk about the numbers at gold prices. I know it's in the chart, and you're welcome to see what the number is, but those are the targets at the time, at an implied of 40% of gold reserves backing the current U.S. debt outstanding that we have. Anyways, let's go to the next chart. Next chart is showing, yes, central banks have been divesting in some cases of U.S. debt recently. But if you think about it, and I know it's not a net selling, so I don't want to be framed as that way at all. But the biggest actually, contributor to the fact that we're not seeing net new demand for treasuries in a big way, that's actually been the Fed, right? The Fed has been doing QT, letting QT is just a quantitative tightening, which is just letting its treasuries mature rather than rolling them over. And the decline of the balance sheet of holdings has been about $1.5 trillion all the way to back to 2022. So, I think that the fact that they're considering stopping QT, this could be a change especially of how we may see even maybe the reversal of that trend. We all know that the U.S. government cannot sustain these levels of interest payments to GDP. And one way to start that is reversal potential to, at some point, start acquiring treasuries rather than allowing them to mature and reduce the ownership of treasuries in the Fed's balance sheet, is to actually stop QT. And so, I think this is constructive from that standpoint. And it's the first step before we get into QE type of policies, in my view. Let's go to the next chart. The history of gold cycles. I think this chart is still, to me, one of my favorite charts, just because it gives a good perspective. First of all, if you average the last two returns that we saw in the first cycle and in the second cycle, first cycle from 1967 to 1980, in this case, the return was about 2,330% of gold in total return. Back in the early 2000s, all the way to 2011, 2001 to 2011, we saw a increase of about 640%. Now, let's use our hats here. The whole point of this chart is to see the listed amount of arguments to why we're seeing a cycle and why we saw a cycle in the past. And the number of that list, as you can see here, of items in that list are substantially bigger today. And I didn't do that on purpose of trying to not add other bullet points. I do think that the bullet points today that are driving gold prices are substantially higher than what we saw back then. We're seeing deglobalization. We're seeing onshoring across most G7 economies, trying to revitalize their manufacturing plants. We're seeing the valuation problem Kevin was referring, potential for inflows into the gold space out of the equity markets. We're seeing unsustainably high fiscal deficits. We didn't see that in the first cycle. We are seeing debt levels that we haven't seen in any of these two cycles. We are seeing a lack of gold discoveries. We are, in my view, in an inflationary era again. Look, and just to mention one thing that I think is even more important, the trifecta of macro imbalances. This is one way to simplify our views, where we're seeing the debt problem of the 1940s, the inflation of the 1970s, and also the asset valuation of the late 1920s and 1990s. All right, well, let's go to the next chart here. I think Kevin mentioned a little bit about the gold, the S&P 500 of gold. I think he was looking at the other way around. I find that very interesting just because, we've been looking at this spike in gold prices over the last 12 or surging gold price over the last 12 or 24 months. And to put into perspective of financial assets, right, this rotation potentially between financial assets into hard assets, let's look at where we are. And today, S&P 500 in gold terms, so just dividing the S&P 500 index by the gold prices, well, we're sitting exactly where we are back in the peak of 1929. Now, I'm not here to say we're going to see a depression like we saw back then. I think there's a possibility of that, certainly given valuations. You have to be open-minded to that. but I think more importantly, it gives you some also a better understanding potentially of that gold is not in a peak at the peak of the cycle, and most likely more in the middle of a major long-term cycle that we are experiencing. Let's go to the next chart. Next chart, I'm looking at that value or that change on an annual performance. So year to date, from January 1st to October 20th, I calculated this change of the S&P 500 in gold terms. It's almost like, the last time we've seen something like this was actually in 2008, when the market was down about 30%. And today, given the fact that gold has been really outperforming the S&P 500, entirely driven by gold, not by S&P 500 declining, right? But it's fascinating that we are the comparison today of the S&P 500 in gold terms is that we are in the middle of a deep recession. It's like your money is evaporating. It's hard. Even if your money is in S&P 500, you're being debased by the fact that there's real inflation, right? I mean, some other macro guy said in a good way, you can't just look at inflation. Inflation is one factor. Let's say inflation is running at 3 to 5%. What has been the debasement of currencies on top of that? I think it's running probably at a 10% rate right now or more. So you add that to those, that's about a 15% total inflation in the system right now. It's hard to catch up. Sometimes I see our own portfolio and I'm like, I'm not sure if I'm happy, obviously, but am I happy or am I, it's a weird feeling because at the same time, I know that the dollars are just, evaporating in value. And it's not just the US dollar, it's all fiat currencies. It's a weird world we're living. I'll tell you that. So anyways, let's go to the next chart. You can also look at the silver to gold to S&P 500 ratio as well, which in my view is a really important, remarkable way to see how silver is undervalued still relative to US equities. I often hear silver might be hitting a top because it's hitting a triple top. Have we not learned that triple tops often don't work? Why anybody would be calling for a triple top? I don't understand it. Some people are usually could be a little bit stubborn, but I'm not going to get into that. My view is triple tops don't usually work, especially when you have a major cup and handle, historical cup and handle like we have in silver. And I think a chart like this, looking at a double bottom in this case, double bottoms and double tops do work, by the way. That's I would not mess with charts that look like that, especially from a long-term standpoint. And so what you're seeing here, which is also being calculated using total returns for the S&P 500, is to me a fascinating chart, most likely the beginning of a rotation out of financial assets into hard assets. All right, let's go to the next chart. All right, one thing that's been happening, gold miners have been tripling, quadrupling. Of course, depends on what mining company you're talking about. Some of them just double. It really depends. I'm talking about over the last years and depends on the time frame. I'm talking generally, mining companies have done very well. If you look at the index, the Philadelphia Stock Exchange Gold and Silver Index, it's up about 2.5x since 2023. But what's fascinating is that the valuation of these companies are actually compressed because the fundamentals of these businesses have improved substantially. In fact, in my calculation of looking at the aggregate free cash flow of per share of the mining companies, what you saw in the last 2 years is actually a free cash flow growth of about 11 times, okay, compared to a 2.5 times of the share price. So that gives you some idea, in my view, of how valuations can really play in your favor when the share price increase is being driven by major improvements in fundamentals. I think this is precisely what's going on here. Let's go to the next chart. Another way to look at the gold miners is also comparing to money supply. We're just starting to see gold miners outperform money supply. I think it's a fascinating chart as well. This is, in my view, a very significant and meaningful and breakout over decades. And I think it's marking the beginning of a trend that potentially gold miners could really not only outperform money supply, but also serve as leverage. Again, leverage works in a good way and a bad way. But leverage, if we are in a gold cycle, that we're potentially in a very positive environment for metal prices. Let's go to the next chart. The next chart, I'm just going to comment a little bit on oil. I think there's a very kind of an implied potential bottom from oil prices, given that the government is now thinking about increasing their strategic petroleum reserves. This was, the news from the Department of Energy. I find it interesting because oil is in a very tricky situation. It's been from a positioning standpoint on the CFTC, non-commercial positioning is one of the most bearish positions we've seen in history. So people are overly bearish, which tends to be a positive thing for assets, the so-called short squeeze. Number two, we're also seeing on the production front in the U.S., number of drills in basins like the Permian declining about 30%, over 30% in the last 2 years. All right, some people that like to be smart butts, they usually like to say there's efficiency happening. All right, no efficiency drives 30% of decline in drill rigs. You can talk to most geologists, nobody believes in that in that near term. Okay, it could happen over a long period of time, but that type of near term efficiency improvement is completely absurd in my view. And a third, we're seeing sanctions. The geopolitical problems are not priced in oil in oil prices today, in my opinion. And lastly, if you look at the gold to oil ratio, it's in an extreme. And usually people try to justify with all these reasons of why these ratios get to extremes and this unreasonable ways of justifying something. And that's where I get really skeptical about those things. Like, if you have hundreds of years of history that gold to silver ratio do not tend to be at these extreme levels, why would you fight against that trend? Now, why would you even come up with okay, we can all tend to come up with, but there's not, I can't find a plausible reason to really support the thesis that the gold to oil ratio should be at these levels for the long haul. And I've been saying this very openly. I think that energy companies look cheap, and fundamentally speaking, and I think it's an incredible way to diversify as well, a portfolio as well. But that's just my opinion. Let's go to the next chart. You can also see this divergence that I think is interesting between commodity producers. It's a MSCI Commodity Producers Index that actually is heavily tilted over energy. So over 30% of this index is energy. And then the blue line is looking at oil prices. Well, that divergence does not stay that way for a very long time. So at some point, I think that the blue line is going to start following what the white line has been doing. And so, I would not be wanting to have a negative view on the blue line here. You may justify a negative view on the white line, sure. But on the blue line, not my view. And by the way, by no means I have the view that the white line or commodity producers are in a negative environment. I think we're in a natural rotational dynamic of the commodity space, and wouldn't shock me at all if energy, after consolidating for over 2 years, it starts to gain some momentum here. Let's go to the next chart. All right, this is an important chart. We're going to dive into now markets in the US very quickly. I'll go quick. But when the dollar turns, the world turns. That's the title of the chart. The white line you're looking at is the relative performance of US markets versus emerging markets. Now, I've said here a few times that I love emerging markets. I think emerging markets are in a very important or pivotal moment as well in history, potentially about to become very beneficial for those economies. There's two things that really help a company or an investment in the equity world is low PE ratio married with or combined with growth, right? Double-digit growth and so forth. We know these economies have very strong correlation with commodities. We're seeing metals, especially metals, actually have a very strong correlation with Latin America and other emerging markets, because some of these countries are some of the largest exporters of those commodities in the world, energy and other things. And so as you see these things being benefited by this macro environment, I suspect that is going to generate growth, and growth, again, combined with extremely low multiples, could be a very explosive combination on the upside, in my view. So pay attention to the whole idea of this chart is to show that the dollar has been rolling over. Yes, I know that the dollar has been digesting a big movement recently. Not my view that this is going to stay here. I think the dollar is going to break much lower, enter a multi-year decline. That's just my 2 cents. And as we see that occurring, we're going to see a rotation, in my view, out of the U.S. equity market into emerging markets. All right, let's go to the next chart. Let's talk about U.S. markets quickly. Transports. That's one way to look at leading indicators in the market. Transports tend to be a leading indicator because it's obviously involved with logistics. It's a great way to gauge economic activity. If you're not seeing the transports leading the way to the upside, raise your eyebrows and start thinking about, well, there's something weird going on here. Tactically, I mean, we can all talk about structurally how equity markets look expensive. I'll be the first one to admit that as well. And I think Kevin will as well, of course. But I think that the red line here looks scary. I think this divergence is what I call an alligator mouth that, usually doesn't end well. We've seen this. This chart is going back to 2020, 2018. We timed that period very well using this, what is called the Dow theory. Is when the transport are making new lows, and the Dow Jones, which is not a great measurement of the overall market nowadays, but it's a great way to see how that divergence tends to actually time the market very well. And so it's a good timing sort of index. Doesn't mean it's going to be right, but it's one of those that you add to your toolkit when you're trying to tactically understand what could happen in the market. So market looks frothy, tactically speaking. We know that structurally as well, but tactically as well. Let's go to the next chart. Next chart is looking at the breadth weakening. So you look at percentage of companies above the 50-day moving average, that has also been weakening as the S&P 500 continues to make new highs. So there's less participation of companies, if you in terms of pushing the index higher. It's scary when you start seeing those things. And actually, if you look at the Russell 2000, the same measurement is even worse. But we all know that what drives the U.S. economy is consumer, right? Consumer spending is a big part of the U.S. economy overall. So if you go to the next chart, where you're looking at is that consumer discretionary alone, that divergence is looking even more scary in terms of only 20% of consumer discretionary companies are above their 50-day moving average. And the index, separated that sector of the economy, is still is at basically a double top, as you can see in this chart as well, which, as I said before, double tops and double bottoms, I respect those trends a lot. I do think those things are real. Let's go to the next chart. It's just a look up. We know CAPE ratios, the cyclically adjusted PE ratio looks, very high. But this is another way to look at just simply looking at PE ratio today. We're at the same level we were back in the tech bubble. We're below the 2021 bubble environment. Do you know what a person does that is just, you can't help it, like in terms of risk and risk reward analysis? Those types of people, they look at these chart and what they say is, well, we haven't hit the 2021 bubble yet. So I don't know. Good luck with that. I like to just move on and focus on things that are more attractive from a fundamental standpoint. And there's plenty of things out there. Let's go to the next chart. Another way to think about it, I think Kevin was talking about Jim Chanos. Jim Chanos is a famous short seller in the market. He came up with this measurement that I've been looking at very closely. It's called the Michael Saylor to Bitcoin premium ratio. It's basically looking at the Michael Saylor MicroStrategy company share price relative to Bitcoin price, and given the fact that the stock is supposed to it's a what they call a treasury company, where people that buy MSTR are usually looking to get exposure to Bitcoin in a leverage way, in a levered way. And so what you tend to see is when that ratio is declining, so people are usually buying Bitcoin rather than MSTR, it simply means that they're trying to reduce risk in their portfolio. So it's a great way to actually, and it's fascinating that it follows S&P 500. And now recently we're seeing a big divergence between the two. So, it's something to be aware of as well. Let's